Analysing accounts receivables. The ways to do so include horizontal and vertical analysis, as well as the use of both the receivables turnover ratio and the allowance ratio. A receivable is an uncollected sale, whereby better collection of these sales means better management of receivables. Therefore, a creditor of a business should be interested in how well the company manages its account receivables. It is also important to note that an account receivable is an asset, as displayed on the balance sheet, as it can be converted to cash at a later date. Horizontal analysis refers to analysing a company's account balance over time and calculates the dollar change in an account balance, which is defined as the current year balance minus the prior year balance. In order to determine the percentage change in account balance, the dollar change is then divided by the prior year balance. Horizontal analysis is very useful in identifying promising or troubling trends in a company. For example, the dollar change in accounts receivables for this balance sheet is equal to minus 4,600, and therefore the percentage change equals to negative 3.8%, which shows that this company's receivables balance decreased by 4,600 or 3.8% in 2008. Contrastingly, vertical analysis involves comparing a company's account balances within 1 year. Vertical analysis is also normally conducted on both the balance sheet and the income statement. To calculate on the balance sheet, we divide the account balance, the receivables, by total assets, and for the income statement, we divide the account balance by net sales or revenue. Another way to analyse management of receivables is to calculate receivables turnover ratio, which indicates how many times during a period a company generates and collects receivables. The ratio divides sales by receivables. A higher ratio is favourable as it indicates that the company collects or turns over its receivables faster, which ultimately improves cash flow, enabling them to meet their obligations sooner. However, the turnover ratio can be difficult to interpret, so is often converted into the days and receivables ratio, which divides the receivables turnover ratio into 365 days. For example, Trinity Bike Shops collects its receivables over 7 times every 50 days in 2017. As previously stated, a higher ratio is better. However, better analysis requires comparison between companies or past years. Finally, the allowance ratio compares the allowance account to gross accounts receivables to determine the percentage of receivables that are expected to be uncollectible in the future. It is calculated by dividing the average for doubtful debts by gross receivables, whereby gross receivables is equal to net receivables plus the allowance for doubtful debts. For example, as displayed on the balance sheet, doubtful debts 1,900 divided by the receivables and doubtful debts added together, 48,300, yields a percentage of 3.9. A higher ratio indicates a company expects more receivables to be uncollected, therefore a company wants this ratio to be as low as possible. Thank you, created by Claudia.